Hey everyone, my name's Ross. I'm making this video to contest the privatization deal of Dorel Industries, and I'm going to make the arguments why it is not in minority shareholders' best interest to approve this deal. So they approved the deal at, they came into a definitive agreement at 1450 in November. To take the deal private, to take the company private. Now, as the board of directors preceding the sale, they have a fiduciary responsibility to maximize value for shareholders, and certainly knowingly planning to take a company private, you would want to essentially have an exit strategy to maximize the valuation of your company to benefit your minority shareholders. That's what I would interpret a fiduciary responsibility. And if I was the CEO, that's how I would have handled it. However, that's not what happened. They don't specify specifically when they decided to initiate this process. They said it was late 2019. However, actions were taken prior that lead me to believe that it was actually sooner that they knew that they wanted to take the company private, such as hiring of Norman M. Steinberg to the board of directors. He was hired in July of 2018. So that was the earliest action as far as the process of taking the company private, because he became the chairperson of the special committee for taking the company private. And in the press release on Dorel Industries website, it states he has focused on mergers and acquisitions, corporate finance, and corporate governance, and has led legal teams in some of Canada's biggest M&A transaction. So I'm going to use this basis point, July 19th, 2018, as the first action showing their initiative to take the company private as the board. So I believe that any steps taken after that should have been in the best interest to maximize the value for their minority shareholders. Many of the steps taken were quite the opposite, quite contradictory of that. For instance, cutting of dividends. In November of 2018, that was the last time they paid their 30 cents dividend, which they were paying $1.20 a year in dividends, and they cut that dividend in half. That was the last time they paid the 30 cents a share, and then they dropped it down to 15 cents a share. And then at the end of the year, at the beginning of 2019, they also depreciated assets. They recorded impairment losses on goodwill, intangible assets, and property, plant, and equipment. Okay, so this is straight from one of their publications. A sustained decline in Dorel's stock price during 2018 has caused Dorel's market capitalization to be significantly lower than the carrying value of its net assets, and as such, the company has recorded total impairment losses on goodwill, intangible assets, and property, plant, and equipment of $501 million in the fourth quarter of 2018. So think about that for a second. They depreciated all their properties and assets by $500 million. That's more money than the entire sale price of all this deal. Now, you better believe that those assets would have been included in the calculation of the valuation of this company. Those would have been included in the enterprise value in a corporate valuation, but they were not. And the basis for them was because the price was trading low, and the price was trading low because dividends were cut. It tanked after they cut dividends. Also, other actions were taken in late 2019, such as liquidating inventory. They claim to have excess inventory and they want to decrease their warehouse costs. So they liquidated inventory. Now, we don't know how much this affected their asset bottom line, but I currently own my own company. And if you liquidate your assets, say have a fire sale, which I can't say for sure they had a fire sale, but if your intent is to move your inventory quickly and get it out the door and you have a fire sale, it's going to reflect in your books because inventory is held as an asset and has a valuation at the end of each year. So if your intent is to liquidate your inventory and you sell it at a discount and you depreciate your inventory by more than what you sold it for, that's going to look as a loss on your books. I hope that makes sense to everybody. I can't say for absolute certainty that that is what happened, but I'd be willing to bet. Okay? And then in October 2019, this was released publicly. It is prudent to suspend the dividend until the chaotic market conditions created by tariffs are normalized, concluded Dorel President and CEO Martin Schwartz. So they cut dividends in October again to 0, 2019. Then they sought a backer, a buyer. They created now, in conjunction with the shareholders, the family shareholders and this buyer, would attain all of the outstanding shares other than their own to create a new company, which they increased their stake based upon the circular. It doesn't explain how their stake gets increased. By my calculations, it looked like they currently own about 20% of the company, but somehow, based upon some things happening, in the end, they end up with 31.5. We don't get to see the agreement between Cerberus and the board of directors, so it's impossible really to know what's required and if it commands approximately $50 million in earnings on their end. I'm just basing that upon a 10% stake in the company increase, or maybe 39 million at this low valuation, which I think it's significantly more. If you look at stock prices with some of the major competitors of Dorel, such as Wayfair, which is e-commerce home products, they're up over 100% from this July 2018 to now. Giant Bikes is up over 100% in that same time period. And Dorel Industries has gone from about $27 a share down to about $14. So about a 40% loss approximately. These are all approximations, but you can dig into them further if you'd like to. With that being said, it is not in your best interest. I hope this is clear, kind of coming to light what's going on here. I mean, you can draw your own conclusions, but if you were to say, hey, before all this stuff, all these processes started, let's just increase the value by its competitors and speculate on where we should be, you'd be looking at about, so going from $27 a share, if it paralleled Giant Bikes, it would be at about $54 a share. And if it paralleled Wayfair, it would be at even higher than that. At the 5 years preceding that July 16th, it was very close paralleling Giant Bicycles. I mean, I'm going to say plus or minus 20% at any given time. Again, feel free to fact check any of this. I'm really hoping that people dig in and become pretty passionate about this and speak out. All this doom and gloom, don't fall for it. It's not in your best interest. You're sitting on a winning lottery ticket. These we just had our best quarter ever. I mean, we had 80 cents a share earnings per share profit. And that makes up 13% of the overall purchase price of these shares. No, that's not accurate. Scratch that. But yes, it is not a good idea to sell. The future prospects are great. You're looking at bicycle stocks, booming. Electric bikes, booming. Stationary bikes, booming. Kids bikes, booming. In-home office products, booming. And now there's news releases saying that we're looking at a new baby boom from the pandemic. We're starting to see this in maternity hospitals, and so juvenile should bounce back just fine. And right now in this market where the Dow has gone up fairly significantly since that 2018, and all other companies seem to be doing fairly well, other than Dorel, right before we got to decide to sell it. It's really unfortunate. Don't do it. Thank you.